Hello and welcome to Investing Confidential. I'm going to talk about China right now. There's been a stock rally, as you probably aware of. Question really is, can you make money right now? Right? Is this rally sustainable? You know, what's the current situation in COVID? What about the economy? I'm going to try to answer all these questions. First, we have to talk about what has caused this rally, and again, why I think it's not going to be sustainable. But let's just talk about what caused the rally. So the protest certainly had an impact, at least publicly. All right, and that's the key here. You got to understand that the Chinese government is more, as I said before. I've been to China many times. I've been investing in China for 25 years. The Chinese government or the CCP is afraid of one thing, their own people. I said this before, I'm going to keep saying it. They don't fear the US, they don't feel the US, they don't feel Japan, they don't feel fear Russia. They do fear their own people. That's why millions of their troops are on the ground in China. They're not out, taking over Taiwan. That's not going to happen anytime soon because they got bigger problems internally. So the protests have had an impact, at least publicly, as I said before. But the government continues to suppress media. They continue to suppress all the things they're doing in a lot of the cities that you don't hear about. So you people are focused on Shanghai, all right? They're focused on Beijing to a certain extent, but there are 100 cities with millions of inhabitants in each city, like 3 or 4 million people. I mean, China is a massive country, and the suppression going on in the media and the people itself, the dissidents they call them, the protesters, is massive. A lot of these dissidents are in jail. Okay, this is why you're not hearing about it. The leaders of these protests have been put in prison. They're gone. No one knows where they are. This is a reality. The Chinese military is in there, suppressing the protest. Okay, so in this country, when we had protests in the past, we never bring the military in. The last resort, they bring in some National Guard people, but I'm talking about hardened troops, not that hardened, but this is the military. They brought into the country millions of troops, and you know what? They got firepower. They're willing to use it. So the protests have been squashed, and the government comes out and says, "Okay, yeah, we're going to do this." Well, the government doesn't say it, but they indicate that certain parts of the country, like Shanghai and Beijing, they're easing some of these code restrictions. Well, before I go into that, let's look at some charts to say, where we are today versus the bottom. Let's look at first what I think is really interesting that nobody really talks about. This is Chinese equity, the beta relative to US. So beta is the volatility. So obviously, if you have the same performance as the US, it's 1 to 1, right? That's what beta means. But look at the China. China is well below the US. It's not correlated. Okay, this is interesting. China is not correlated to the US, especially over the last few years, especially recently, and that means China's a good place for alpha. All right. So if you're, an investor and you've been struggling with the S&P, struggling with the US, you can find some alpha in China, right? I'm an international guy. I think the international is the way to go, especially going forward. But up or down, China's a good place for alpha, okay, relative to the US. So let's look at this first chart here. This is a long-term 10-year chart of China FXI. Now, the problem with this chart is FXI has changed components a bit here and there. The people that manage these indexes do this to manipulate them, but FXI may have bottomed in this recent down move this year, but it's not going to be a straight line up. Okay, we've had a big rally off the bottom again recently, but I still think we've got a ways to go before we recover get to new highs. We've got years to go before we get to new highs, and we'll get into that later. Here's a shorter term chart of FXI hitting resistance. Okay, certainly the 200-day moving average is a resistance level. We're at there right now. What do you think? Do I think it's going to break? Do I think it's going to pull back? Let's continue the charts, and I'll give you my opinion in a few minutes. Here's Yum China, an opposite, on a breakout. Yum China owns, KFC, all of these fast food restaurants. It's obviously consumer. They've been doing well, believe it or not, through all this, and it makes sense to doing well. That this is cheaper food. People aren't going to restaurants, but they're going to these fast food places like Yum China, and they're doing fairly well. It's a defensive, believe it or not, it is defensive, and it is breaking out. Okay, I don't know if that's sustainable, but let's continue. Here is Alibaba, so the mainstay, or at least for the U.S., what a lot of traders like to do to follow what's going on in China. They use Alibaba as as a placeholder, because it is a good company. It has been depressed by the Chinese government. Jack Ma, who founded the company, he's buried somewhere. No one sees him anymore. He's been actually muzzled by the Chinese government. But Alibaba again has rallied off the lows. Again, like FXI, which is a big percentage of Alibaba in FXI, it's hit a resistance level. Here's the rival of Alibaba, JD.com. A breakout here. JD is probably a better company because it's more focused on e-commerce, et cetera. Alibaba's into a lot of other things. JD.com has broken out. It is also, they have operations outside of China. Alibaba is really China-centric. JD is in Indonesia and other places. So, JD's broken out. Fair enough. That's what the chart says. Things are going okay, at least from a chart standpoint. Here's China ETF. Now, the China real estate ETF is a legitimate ETF. It has all of its holdings are Hong Kong listed real estate companies, Chinese real estate companies. And again, it's had a big rally off the bottom, but hitting resistance. Finally, this is what I would call sort of a more legitimate indicator. This is the Hang Seng Hong Kong Index. It's an index that makes up mostly of Chinese companies listed in Hong Kong. This is real buying. Again, big rally off the lows. We're hitting resistance. This is a mixed picture, folks. It's hard to know what's going on, but I think when we go through the what's going on in the real economy and what's going on really with COVID, I think you realize that my conclusion is we've reached resistance. It's time to go short. It's time to sort of get out if you've rallied. I think China is not going to break out here. There's too many problems, and let's go through those problems right now. So again, it's a mixed picture. Start with COVID. COVID cases continue to rise. They're through the roof. And if it's true that China is going to allow people to move around, these COVID cases are going to continue to go higher. And so, what's the pain level for the Chinese government? Well, we're sort of reaching pain level here. Look at this. Beijing, they're running out of medication. They're publicly saying they're running out of medications to treat COVID patients. I don't know what medications they're using to treat COVID patients, but this is the reality, and so that's a concern. This is an opinion article right here. Government bracing for more deaths. Are more deaths going to come? Well, historically, it tells you that since this virus has, mutated over time, it's been through a lot of hosts, that we're not going to see a lot of deaths following up these cases. Okay, I think this is partly the fact that you have, you see a lot of media press, and people get scared when they hear COVID, and the Chinese people especially, they're very scared of COVID. But realistically, given the science and what's happening around the world, you're not going to see a lot of deaths, which is actually a positive thing. As we stated earlier, China's still censoring. Okay, they're still censoring the World Cup. They're not showing fans out there without masks. That's still thing. This is a media censorship that's going on. And the reality is that the Chinese government knows that their economy is damaged. Okay, there's a tough road ahead, folks. As you see, there's a really tough road ahead. These lockdowns, as I showed, this is another chart I've showed before, have affected 70% of the Chinese GDP. 70% of the Chinese GDP around the country have been locked down. You just don't recover automatically from that. It takes a while. This is one of the more reliable Chinese indicators. It's done by a private company that is not based in China. China Cash-in PMI. The PMIs are still crashing. Purchasing Managers Index. This is a very good leading indicator for the economy. It is still crashing, still in decline. As we talked about, PMIs, the actual number is not as interesting as much as, is it below 50 or above 50? If it's below 50, the economy is in contraction. If it's above 50, the economy is expanding. China's PMI has been below 50 for a while. It continues to go lower. It's going to take a while for it to recover. Okay. Will this lead to recession? Who knows? The Chinese numbers are not reliable. The Chinese economy is probably in recession today, but you'll never hear that from the Chinese government, because, like this government, unfortunately, as I said before, and you can look at some of my past videos, they manipulate the data. So The real data tells you that China is in recession. Okay, that's the bottom line. Now, as I always spoke about real estate has been the key to the Chinese economy for 25 or 30 years. It is the engine of growth, no matter what anyone tells you. It's all only that matters. Okay. All this high tech stuff is great, but real estate development is the only thing that drives the Chinese economy. Now, are we seeing signs of a recovery? Here's a chart. Some of these people say yes. Most likely it's stabilized. I wouldn't say it's recovering, but it definitely has stabilized. People are not buying homes. They're not, paying their mortgages. The banks have been bailed out by the government. So we're in a stability mode right now. What's it going to take for the Chinese real estate to recover? Well, very simply, consumer sentiment. Consumer sentiment has dropped dramatically. You're going to have to get through this COVID wave. Okay. As soon as the COVID wave is over, okay, then people are going to have a brighter outlook on consumption, and you're going to see the real estate companies begin to recover, right? The real estate begin to recover. You can follow the real estate ETF to do that. And once that happens, then you're going to get a sustainable rally in China. So what do you watch here? Obviously you could pay attention to this ETF. I think it's gonna again, this thing is at resistance, probably going to come down. But as soon as COVID begins to fade, as it will, okay, COVID is never around forever. It's going to fade. Then you're going to see measures come in. The Chinese consumer will certainly have a brighter outlook. Their consumer confidence go up, and that's when you're going to see a big move in the Chinese market and a big move in the Chinese economy. So, what to do now? I would fade the rally we've had, fade it, short it, sell what you have. Watch these numbers, watch the real estate, watch especially the COVID. When the cases start going down, that's going to be a sign that it's reached its peak. It's going to take a while because China's an economy, a country with a 1 point, something billion people. It's going to take a while, but it's going to happen. And at that point, that's going to be your buy signal. So for now, investors, be careful out there.